everybody. This is Alan Ellman, the Blue Collar Investor, and welcome to this BCI podcast number 85, titled Automating the Covered Call Writing 20%, 10% Guidelines. We're going to use a real-life example with Invesco QQQ Trust, which trades on the NASDAQ exchange under the ticker symbol QQQ. Now, the 20%, 10% guidelines are used when we enter a covered call trade and share price begins to decline. So let's give a generic description of how the 20%, 10% guidelines for covered call writing are implemented. Let's assume we buy a stock and then sell the covered call option for $2. That, of course, is known as selling the covered call. Now, we would buy to close at 40 cents, which is 20% of the $2 initial premium in the first half of the contract. That is the 20% guideline applies to the first half of an option monthly contract. Now, we would change that 20% to the 10% guideline. In this case, 10% of $2 would be 20 cents. So we would buy to close at 20% or lower in the latter half of the contract. That is the 10% guideline. And these guidelines are based on the logarithmic nature of theta, which is time value erosion. What that means is at the beginning of a contract, theta or time value erosion starts off very slowly and incrementally. But towards the latter half of the contract, it literally falls off a cliff. So in the second half of a contract, there's much less opportunity to generate additional time value premium. Therefore, we're willing to spend less money to buy back that original short call. And that explains the 20%, 10% guideline or the rationale for it. Let's turn to a real life example with QQQ Trust, which at the time, this is actually taken directly from one of my portfolios where I purchased 100 shares of QQQ Trust. As you could see, I purchased it for $245.15. The reason we do 100 shares is for every one option contract that we sell, we must first own 100 shares of the underlying security in order to be covered. Now, after purchasing the trade and buying the shares of QQQ, we're then covered or protected, and now we could sell the covered call. In this particular case, I opted to sell the out of the money, higher than current market value, $249 call, and that generated a premium of $510 per contract. Now, once that trade is executed, I immediately entered my buy to close limit order at 20%. So what's 20% of 510? It's about $1. So I entered a buy to close. We sell to open at 510 and then a buy to close at $1, good until cancel. Good until cancel, which means that until we change it, that order will remain in place. And if the share value of QQQ declines, bringing the value of that option down to $1 or less, that trade will automatically be executed. So we're partially automating this 20%, 10% guideline. Now, we also then place a note on our calendar to change it to 10% on July 6th. That's moving into the final 2 weeks of the contract. And that, of course, assumes that the 20% threshold was never reached. So we do make a note in our calendar. We have to go in and physically change it, but pretty much we don't have to be in front of our computer all the time to be protected by these guidelines. Okay, now on July 6th, we then changed the 20% guideline, which was, remember, the limit order for $1, to 10%, which is now 50 cents. So we cancel one, and then we place the second. So we'll always be protected. The beginning of the contract, the middle of the contract, and the end of the contract will always be protected by these 20%, 10% guidelines should the share price decline. Once again, remember to enter these trades as good until canceled. Let's summarize. Exit strategy execution is so important. It's the third required skill necessary to become an elite option seller. Now, implementation of the 20%, 10% guidelines can be partially automated by entering a buy to close 20% limit order immediately after entering our trades. In the final 2 weeks of a monthly contract, that 20% buy to close limit order is changed to 10%. If we're using weeklies, then we only use 10% limit orders. Now, if the short call is closed from these buy to close limit orders, now we're in a position to take additional action. What are we going to do? Well, we could roll down, we could sell the stock, close the entire position, or we could wait and look to hit a double, which means if the price of the stock recovers, we can then resell the very same option twice in the same contract month. All this information on position management of our covered call trades is located in all of my books and online video courses, as well as a myriad of articles and Ask Alan videos that I've made over the years. So the information is all there, but we do have that protection of these 20%, 10% guidelines against share decline, which can be partially automated. Before I go, folks, I just want to remind you of all the free resources on our website, www.thebluecollarinvestor.com. Look for the free resources link on the top black bar of all of our web pages. Check out our free Beginner's Corner tutorial. We have one for covered call writing and one for selling cash secured puts. They're both 8-part video tutorials, about 10 to 15 minutes each video, give you an overview of these strategies. And visit our store, which has spreadsheets, calculators, online video courses, ebooks, softcover, hardcover books, a trade planner, and online mentoring program. So everything is available to bring your level of knowledge of these option selling strategies up to the master's level. Ladies and gentlemen, thank you so much for taking the time to watch and listen to this BCI podcast number 85, titled Automating the Covered Call Writing 20%, 10% Guidelines. Folks, I hope you enjoyed this video, and most importantly, I hope it puts cash in your pockets. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.